Good afternoon, everybody, and thank you very much for joining our Investing in Retirement, which is the second webinar in our Retire Ready Financial Wellbeing series. My name is Kirsty Johnson. I'm the Wellness Programme Manager here at Somerset, and I will be looking after the webinar today, mostly just in the background, however, popping back on later on to help facilitate the Q&A. The way that this is set up is a webinar. Unfortunately, we can't see or hear you. However, you should be able to see and hear us. And despite this, we do love this to be as interactive as it can be. So you should be able to see a Q&A function either at the top or the bottom of your screen. Please feel free to pop any questions or comments in there at any stage during the webinar, although we will try to keep our questions for towards the end. With that in mind, the session today will last approximately an hour, with the first 40 minutes or so being for the presentation and the remaining time at the end, as we said, for the Q&A. So I think that is the boring part, the housekeeping. So without further ado, I will pass you over to our host for today, Liz Coe from Enrich Retirement. Welcome, Liz.
Thank you very much, Kirsty, and it's good to be here again for another one of these webinars in the series. So just by way of introduction, I was a financial advisor for well over 20 years, and I sold my business a wee while ago. But what I'm going to share with you today is a lot of information that I gathered over that time, working mostly with retirees, looking at how to help them invest their money in retirement. So, and it's, I always felt quite privileged, I guess, to be a financial advisor because, it's not often you get to talk to other people about what happens in the financial arena. It's quite an intimate subject, actually, money, and people don't often like talking about investments and how they manage their money. So I learned quite a lot of things while I was an advisor. Mostly, I guess, I learned a lot from my clients as much as anything. So what I'm going to share with you today is some basic principles and tips that I hope will be helpful for you. So let's rock on into it. So today we're going to be talking about how to use your investments to top up your super, because as we know, it's really, really hard to live just on ended superannuation. And I guess one of the things that we need in retirement is to make sure we have money available when we need it. So, I guess, the thought behind that is that you work so hard through your lifetime to build up your savings. And then what do you do with them? The key aspect of using your money in retirement is to make sure that when you want to spend that money, it's available to spend. Because that's what you work so hard for, is to enjoy your retirement. So you don't want to have money tied up in things where it's not easily accessible. So your key goal, if you like, when you're managing your money in retirement is to make sure you've got money available at the time that you need to spend it. I'm going to talk a little bit, I'll cover a little bit about how to make sure you've got enough money to cover your retirement village fees. So if you're thinking of moving into a retirement village, and some basics on how to set up an investment portfolio, because it's not something that people have a lot of expertise in as they enter into retirement. Often we use a passive vehicle such as KiwiSaver or putting money into bank deposits and that kind of thing. And so it can be quite a challenge, I guess, to have the knowledge and experience to know how to go about setting up your own investment portfolio once you retire. And of course, the goals are then different. So as you're growing your portfolio, your goals are all about growth and high return. The minute you retire, and by that I mean you are now relying on your investment portfolio to provide income, then your investment goals have changed all of a sudden. And so the way you invest as you're building up your wealth is a lot different than the way you invest once you are in retirement. And actually, just before we go any further, I do need to point out that I'm going to be talking about a lot of different things today, which are quite specific. But please just bear in mind that what I talk about today is just general advice, and you should really go and see a professional expert if you want to know how some of the things that I talk about today don't impact on you personally. So don't assume that whatever I talk about today is necessarily relevant to you, right? So please go and get some advice. This is just general information, and by all means go and see someone to get expert advice about how to interpret what I say for your own personal circumstances. Right, so where do we start with this? Perhaps we'll move on to the next slide. So planning your investments. So really the key objective when you're retired is to think about how and when you want to spend your money, as I was talking about earlier. So that's the driving force behind your investment strategy. You've got this bunch of money when you first retire. What are you going to do with it? When are you going to spend it? Because the thing about money is it has to be spent by somebody. If you don't spend it, then guess what? Your children or the beneficiaries of your estate are going to spend it. So I guess the first question to ask yourself is, who is going to spend your money? Is it going to be you, or is it going to be someone else? And maybe you have a plan to leave some money to charity, or maybe you're going to spend it all. A lot of people in retirement use what they call the ski principle, spend the kids' inheritance. So a lot of people take the view that by the time they leave this world, they have not a lot left other than the house they live in, and that's what goes to the beneficiaries of their estate. But it is a key decision to make, and there's no right or wrong answer to who is going to spend your money. Some people want to leave a big inheritance for their children, other people don't. It's very much a personal choice, but you do need to at least have a rough idea of what that balance is between you spending and someone else spending. So put a stake in the ground and say, well, I want to leave behind the house I live in plus X amount. So the difference between what you have now and what you plan to pass on to someone else is what you get to spend in your retirement. So the next key question is, when are you going to spend that money? Are you going to spend it now, a little bit later, or a lot later? And I guess, again, that's very much a personal choice, because some people want to have a really good time in the early years of retirement, spend up big time doing lots of travel, and then, have the thought that perhaps they'll come back and have a quieter life. And others are the opposite. They want to sort of keep money in reserve in case they need it at the end of their lives. So that timing of when you spend is really important. And of course, there are factors to consider in that, in terms of your health status. Are there health-related expenses that you might need to plan for? Where you're living might have an impact on that too, in terms of if you're still in your family home and it might need some maintenance, or perhaps you might need a new car sort of 10 years down the track. So try and think about, when, especially those big lump sum expenses might pop into your retirement stage. So once you've really thought about those two questions, then it makes it a lot easier, because then what you've got to do at that point is then decide how to invest your money until such time as you spend it. So that's the driving force. When you're going to spend the money, where is an appropriate place to have that money invested so it's available in the time frame that you need it. Right, moving along to our next slide. So I guess the key problem area for retirement is that one of having your money tied up so you can't spend it. And the biggest mistake that retirees make is that of being asset rich and cash poor. So your money's tied up mostly in your house and you've got a little bit of cash, or you might decide to not to spend your investment capital and just live off the income. So really, you need to have a different view about money when you're in that retirement stage, because the most important thing to remember is that you just need money. You shouldn't really care where that money comes from, whether it's capital, that's the lump sum that you've set aside, or whether it's the return on that capital, so the interest or the dividends. The point here is that you just need money, and your investment capital can be used to top up your income. So even though it's a lump sum amount, you can draw down your capital over time to provide a top up to your income. And you probably should be doing that, because if you try and preserve your capital and just live off the return on it, you're going to need significantly more than if you're prepared to run your capital down. So rather than thinking about, investment capital and return on capital, just think about money. You have a certain amount of money available to you as a lump sum or as income off that lump sum. And, so both can be used to top up your income so that you can avoid being asset rich and cash poor. Okay, the next slide. Thanks, Kirsty. So just to illustrate my point about living off the return. So if you run down your capital, for every $10,000 of income you want per year, you'll need about $180,000 of investment capital. And that's based on a few assumptions about investment return, and it's based on a 20-year time frame for retirement. So, but if you want to retain your capital and just live off the return on that capital, then you'll need $1 million to last the distance. So you can see there's a substantial difference. So these days, I think most retirees accept that they can't leave their investment capital intact. If you want to have a comfortable retirement, which is what you deserve after all, you've worked so hard for it, then you need to be prepared to run down your capital. And of course, the big question then is, how fast can you run it down so that you don't run out of money before the end of life, which is, I guess, the second big mistake that people can make. So I'm going to give you some tips on how to do that. Next slide, thanks. So it's all about planning, really. If you are going to run down your capital, then you need to really break up your retirement into the 3 stages. And I have talked about this before, I think. So because a lot of people now live around 30 years or so in retirement. And that's a long time. It's, for most people, it's a third of your life. And it's really hard to, well, firstly, it's hard to predict how long you're going to live. So I guess the most conservative way to deal with that is to assume you're going to live a long time. Most people now live to, well into their 90s. That the life expectancy is increasing quite rapidly. So the most conservative approach is to plan to live a long time. And if you die sooner than that, well, I guess the beneficiaries of your estate will inherit a bit more than you were intending them to. But, the worst possible thing is to run out of money before you die. So let's assume you've got 30 years or so if you're just starting out in retirement. As I said, it's really hard to kind of work out what you need to spend and when over that time frame. So my suggestion is you break that retirement phase into 3 stages. And I call these stages the live it up stage, the fix it up stage, and the wind it down stage. So live it up is where you are still relatively young in retirement terms, and you're fit and healthy, and you've got things you want to do. So you've been dreaming about this retirement for probably a couple of decades and thinking about all the wonderful things you want to do. So my advice is set aside an amount that you want to use up in that stage out of your retirement capital. So if you remember, we said, work out how much you want to leave the kids, how much you've got now, you've got to spend the difference. You've got to run your capital down. So of that amount, how much do you want to use in that early stage of retirement that I call the live it up stage? So you have a kind of a ring fence around that money and a sort of a goal to aim towards. And so this is when, you know, you do your travel, you join the golf club, you go out whining and dining, go to shows, all that kind of thing. Then you have the next stage, which is what I call the fixing up stage. And that's a stage when things do need repairing and maintenance. And that's not only the house that you live in, it could be your car, but it's also your body. So you tend to get a lot of the health expenses in this stage. So, you know, maybe you need hearing aids or cataract surgery or some other sort of elective surgery. Perhaps you don't want to go on a waiting list for a hip operation, so you might want to budget for that. And also in that fix it up stage is when, so your surroundings probably need a bit of a zhuzh up. A lot of people, when they first retire, they get everything looking really nice. You know, perhaps if you're moving into a retirement village and it's all nice and brand spanking new, but a few years down the track, it might be looking a bit tired, and it needs new carpets, new furniture, new curtains, whatever. So there's a lot of that sort of maintenance expenditure in that stage. Plus you're probably a new car as well. Then we've got the last stage, which is what I call the winding down stage, and that's where you perhaps need to move into some sort of care, assisted care, or perhaps you might want to provide for someone to come and look after you in your home rather than go into a care facility. So I think with all these stages, again, it's just about visualizing yourself in each of these stages and saying, well, what kind of things might I want to spend money on during those stages, and having a bit of a budget. So you're allocating your capital to those three stages. So then that helps to kind of pace you so that you don't run out of money before the end of life. Now, those stages can be as short or as long as you want, really. So, and if we move on to the next slide, just to see it represented in a bit of a graph. So using up your capital. So you can decide to use up quite a bit more in the early stages, or sorry, it's a bit of a rough graph that I've done here, but there's a different shape to everybody's curve. So you can do it sort of like on a straight line approach, or if we move to the next one, the next graph, you can use up quite a bit in the early stages and spend a bit less as you get to the later stage. Or if we move to the next one, you'll see that people are hanging on to their capital a bit longer and they're spending it in the last stage. So everybody has a different shaped curve in terms of how they run down their capital. And so that should really be a conscious decision as to what shape your curve has. It does really require some thought, and the more thinking you do and planning ahead, then the best you're going to make the best use of your money, because you've got two extremes here. One extreme is that you run out of money before the end of life. The other extreme is that you don't spend enough and you actually end up leaving money in the bank, and your children or your beneficiaries of your estate get to spend a lot more than you intended. So we try and sort of plan that neither of those mistakes happen and find the happy middle ground. It's what I call, I guess, the Goldilocks factor. It's just the right amount of capital being used up through your retirement. Okay, let's move along then. So your investment strategy then is very much geared to your time frame. So, just to recap, you've worked out how much you want to spend over your lifetime. You've looked at the different phases, to live it up, fix it up, and wind it down. And so you put your money into those three different categories or buckets. I like to use buckets when I talk about money. So your challenge then is to invest your money until such time as you want to spend it. So the way you invest money for that first stage, the live it up stage, is going to be a lot different than the way you invest money for the end of life stage, because you've got a different time frame involved. So you want to have money set aside for, when you first retire, into that live it up bucket and short-term investments, because you need to get your hands on that money quite quickly. So that means things like, cash, term deposits, bonds, those kind of safe things that don't vary much in value, because you don't want to be putting money in investments that might suddenly drop, 20 or 30% in value, and you've got to wait 5 years for the value to be restored. And I guess you've seen that a bit with what the share market's done in the last wee while, where it dropped significantly after the big boom we had around those COVID years, dropped significantly back, and now we're still growing. So that short-term spending money needs to be held somewhere that's safe and secure and stable in value. At the other end of the spectrum, you've got money that you're not going to need until that last stage of life. And that could be, 15, 20 years away from now. So that needs a very different investment strategy. If you held that money in short-term deposits, then it wouldn't make a good return. You would not keep up with inflation. By the time you take taxes into account, you're going to be behind the 8 ball. So it's always good, I think, to set aside an amount of money for that late stage of retirement that you can put into some growth assets that are going to give a high rate of return. So you park it in that long-term bucket, then you know that your long-term future is catered for with that bucket of money that can just stay there untouched until you are ready, until you've reached that stage of retirement. And then, of course, in between, we've got the medium-term money, which needs a combination of the two. It needs, some safe and secure, stable investments and some growth investments. But it's more that medium-term investing. So you need a little bit of growth there. So really, your investment strategy in retirement is driven very much by when do you want to have access to the money for spending. Okay, moving along. So here we go. We've got our 3 buckets set up. So we've got our long-term investment bucket, which is set up in a growth fund of some sort. Our medium-term bucket for our fix it up stage, and our short-term bucket for live it up. So the way the system works is that with short-term live it up bucket, you do need to spend that money. If you've said, okay, I'm going to spend, X amount in that first phase, then you do need to spend it. So that by the time that phase is finished, at whatever time frame you've specified for it, there should be nothing left in that bucket. It will be empty. So that's the bucket that is used to top up your income, so you can add to your NZ super and also pay for any lump sum expenses you've allowed for in that time frame. So that money is gone, spent, which is what it's meant to be for. It's for spending. So when that money is gone, what we need to do is, for those of you who've been to Wellington and seen the bucket fountain in Cuba Street, it's like tipping money from one bucket into the next. So it's a bit of a trickle down thing. So the bucket above that we have for our medium term then trickles down and becomes our short-term spending money. So that investment money needs to change. It needs to go from a sort of a medium growth strategy into short-term, safe, secure investments. Not necessarily all at once. You might maybe want to transfer it over in bits as you need it. And then, of course, we've got our long-term growth fund bucket, which trickles down into the medium-term bucket. So as you can see, that you get a trickle-down effect until you get to that last stage of life, the winding down stage, And by then, most of your investments should be in safe and secure things, such as bank deposits and so on. And you've got rid of all your long-term investments because if you're 90 or 95, you're not really investing long-term unless you're doing so for the sake of your children or your grandchildren. So that's what we call the bucket system for managing money. And I'll just talk a little bit more now about how to set up those investments in those different buckets. So, if we're looking at different investment portfolios, so for our middle bucket, we're looking at a balanced portfolio. What do we mean by that? A balanced portfolio is where you've got a combination of what we call the income assets, which are the safe and secure ones, and the growth assets, which give you the high return, but which are quite volatile. So a balanced portfolio is roughly about 40% income assets and about 60% growth assets, give or take. As compared to your long-term bucket, which will be a growth bucket. So that's a different percentage. So we've got about 25% income assets, which is your stable things, stable investments, and about 75% in your growth assets. So investing is very much a process of managing what we call the asset allocation, and you might have heard that term used before. So what I'm showing you there is two different asset allocations, one for balanced and one for growth. That shows how your money is allocated between income assets and growth assets. And that's a very, very important concept to understand. It will be the key driver of two things. It will drive the return on your portfolio and the volatility of your portfolio. So the more income assets you have, the more stable your investments will be, but the lower the return will be. The more growth assets you have, the higher the return will be over the long term, but it will be a more volatile road to the end. So lots of ups and downs. So we need to understand that before we start. So a lot of people do say to me, well, I'm retired. Should I be really investing in risky assets such as shares? Because as we've seen, they are quite volatile. So there's really, there's no way of avoiding risk. Whatever you do, there is risk. If you put all your money in the bank, you risk running out of money and having a very, a relatively impoverished retirement. If you put all your money in shares, then you risk having to pull it out at the wrong time and losing in that way. So the key thing with investing in growth assets is to follow two key principles to manage the risk. And these are very, very important principles. So the main one is diversification. So if you are investing in shares, you want to make sure that you are well spread. And if you don't have a large amount of money, then using managed funds and so on to get that spread is a much safer way to go. If you've got a very large portfolio, you can invest directly. But again, just make sure you're invested in lots and lots of different shares. So if you diversify, then if any one investment fails or suffers some tragedy, it's not going to have a huge impact on your total portfolio. So that's principle number one. The second principle is time. And so the more your portfolio is weighted towards these volatile assets, the longer your time frame needs to be. So if you're going into a growth portfolio, you need probably at least 10 years plus of investment time frame so that your investment can go through the ups and downs. But at the time when you need to spend the money, it's at a point where you've made a good return as compared to when you first invested the money. So it will be up and down, but over that length of time, it should do well for you on average, as you see in that graph there. So don't be scared of volatility. If you have time on your side, it is nothing to be worried about, providing you have diversified your portfolio. Okay, moving on to the next one. So what we can do in terms of creating more certainty around our cash flow for expenses I've talked about having a number of different buckets, for your short, medium, and long-term investing. But you can have as many buckets as you want. So, for example, if you're worried about how would you pay your retirement village fees, if you're going to a village, because that's a commitment you need to make, you can set up a separate bucket of money that's designed to be used up over your expected lifetime and just draw down on that. So it could be, like in a balanced investment strategy or even a growth one, but just to be pulling off a certain amount per month to pay those fees. If you plan to do a lot of travel at a particular point in time, and some people like to do lots and lots of travel and can end up spending, a couple of $100,000 on travel at the extreme. So maybe you've got a bucket that's identified just for travel in a particular time frame. You might have a bucket for car replacement. So if you know you need a new car at a certain period of time, maybe you need 35,000 or so, or even more set aside, put that into an investment that's earmarked car, and then you'll know it's going to be there when you need it. So you can play with this as much as you want. Obviously, the more buckets you have, the more complicated it gets in terms of managing your overall portfolio, but it certainly does make it a lot easier for planning periods. So the key principle here, though, is always to link your investment strategy to your investment time frame. And I know a lot of you will have heard the term, risk profile. What is your risk profile? What's your tolerance and capacity for risk? And I guess, people do have different attitudes towards risk and returns, but really that is manageable. And for me, the most important driver is when do you want to use the money? I mean, if you're one of these people that just simply cannot bear the thought of your money going up and down, even though you're not going to be planning on using it for 15 years, then you might want to not go beyond a balanced bucket. So it is certainly a consideration, but really, providing you've got the time frame and the diversification, it should not be a risky strategy. Okay, let's move on to the next slide. So I guess just in summary, the key things to think about are, who's going to spend your money? Is it going to be you, or is it going to be somebody else? And that is different for everybody. When will your money be spent? And this will very much influence your investment time frame. And lastly, the key thing is to match your investment strategy to your investment time frame. So, I hope that's given you some pointers. And, I guess there are options in terms of how you set up those investment portfolios. I would really encourage you to use a financial advisor, because quite honestly, as I mentioned earlier, the key driver for your investment performance is what we call the asset allocation. And that's where a financial advisor can add a huge amount of value to you in terms of guiding you on the asset allocation. It does need to be managed. And just to give you an example, say if you had 100,000 invested in a portfolio of which 60% was shares. Let's say the shares go up in value to 120. By 20,000. So you've now got 120,000 in your portfolio. That then means that the shares are a much bigger component, a bigger percentage of your portfolio than 60%. So you need to rebalance that. And this is a really where the secret lies in terms of managing your investment portfolio, is to manage that asset allocation, so that when shares go up significantly in value, you sell some of them off to keep that balance in check, so that you've always got what you've set as your asset allocation. If you want 60% of shares, 40% of fixed interest, then keep that balance. So when your shares change in value, either if they go up in value, sell a few off. If they go down in value, then perhaps buy a few more. And if you do that, you will make sensible decisions about your money, because it means then that you're selling shares when they're high and buying them when they're low, which is probably the opposite way to what a lot of people do. So I guess people who are managing their own portfolios don't necessarily see it that way and end up doing the wrong thing. So the role of an advisor in this process is to help you in that process to make the right decisions and do the right thing, so that you're not selling up your portfolio at the wrong time, which is when it goes down. I mean, that's when shares go down in value, that's the time to be buying, not selling. And so long as you've got that time frame in mind, then you really have nothing to worry about. So really think about getting some advice on managing that asset allocation. That's the most important thing. Whatever goes into that asset allocation, if you've said 60% shares, the shares you choose to fill up that allocation, that's a far less important decision than the percentage allocation. So really, investing is not rocket science, but it's probably something that you should do with some help. And for me, although I've got over 25 years experience in investing, I don't manage my own investment portfolio because I can't keep up to date with the latest trends of what's happening. There's other things I want to be doing with my time other than sitting and watching my investment portfolio. So I have an investment advisor that looks after my portfolio, and really it's even though you're paying fees, it's very much it is a very good safety protection and gives you better performance over the long term. So right, I think that's the last slide, Kirsty. So we just we'll talk a little bit about the next steps and resources, if you'd like to talk about that for a minute.
Yeah, sure. Thank you, Liz. So in terms of where to between this webinar and the next, we do have a page on our website. So www.somerset.co.nz/retire-ready. And there, if you missed our first webinar, Planning for Retirement, the recording is there. This webinar, if you wanted to revisit it or share the link with anybody else, the recording will be available to view there in the next couple of weeks. We'll pop that there too. And we also have our Retire Ready Planning Workbook. So there's a lot of resources in there. Liz has compiled those that allow you to work through and plan your retirement and talk a bit more about buckets and things in there. So you can download that for free, also from the website, and doing so will give you a 40% discount code. So if you wanted a wee bit more webinars and written resources, all those kind of things, they are on Enriched Retirement's website, which Liz will talk a little bit more about now.
Yeah, so thank you, Kirsty. So what I've done on my website, enrichedretirement.com, is I've put together everything that I can possibly think of that you might need to plan your retirement. And it's actually not just about money, it's a holistic view of retirement. So we talk about all sorts of issues that crop up. I interviewed a lady recently about things like body image. We've got interviews with the guy from the Men's Shed talking about how Men's Shed helps with mental health for men. There's all sorts of stuff on there. I've got courses that you can work through. I've got even a yoga course if you're into yoga to keep fit. So there's lots and lots of information on there because the aim is for you to really, really enjoy your retirement. And so it covers every single aspect, your financial as well as your physical, emotional, your well-being, just really how to have a fantastic time in retirement. So I do encourage you to go and have a look. There are some free resources on there and some resources that you need a paid subscription for. But as Kirsty said, we've got an arrangement where you can get a big discount on that membership fee.
And I think also there's no set time that you necessarily have to sign up for.
That's right. You can cancel at any time. Yeah, so go and have a look.
Super. And our next webinar will be on estate planning. So if you would like to join us for that, we would love to see you there. That will be on Wednesday, the 16th of October at the same time of 3 o'clock. If you're here now, you will already have registered. So if you don't unregister, you will be able to get a reminder for that ahead of time. And if you think of any questions between now and then, we also have an email address, retire.ready@somerset.co.nz. And we'll keep everything anonymous. So if you have any questions for that session or any comments after this one, please let us know. So the next slide, I remember from last time, implies that we are finished for today, which we are not. So I will just stop sharing my screen so that you can see Liz a little better there. And we will move on to our questions. So we have a few here, Liz. You mentioned buying shares when the market is down. From which bucket does this come?
Well, I think it's really more about rebalancing your medium or your long-term buckets. So when shares are down, you might want to do a bit of a switch between fixed interest and shares within that bucket. So as I was explaining earlier, when shares change in value, it changes the percentage asset allocation for that bucket. So if they drop in value, they'll be less than whatever you've set as the percentage for your long-term target. And so then you have to rebalance by selling up some cash or fixed interest and then investing in the shares. So just do it within the one bucket. Or if you're finding that you've got a bit too much cash in your short-term bucket, you're not spending it as fast as you thought, then of course you could put some of that into your medium-term bucket.
Super. And of the growth assets, in terms of shares, would you advise a US EFT like S&P 500 or a mix with New Zealand shares?
Look, again, it's the old principle of diversification. You want some New Zealand exposure, you want offshore exposure. Without getting too technical, there's lots of different products, types of products you can invest in. You can invest in the EFTs, exchange traded funds, or you can invest in index funds. You can invest in managed funds that where you've got an investment manager making decisions and choices for you. So there's many different options with pros and cons. So some of the funds, like the more passive funds, have a low fee structure, but that can have some downsides because if the market goes down, then they're usually pegged to some sort of benchmark and your investment will go down along with the benchmark. Whereas in theory, a managed fund, which is hands-on managed by a fund manager, if the market's heading down, they can take some corrective action. And so although you're paying higher fees, it helps to smooth out some of the ups and downs. So look, really, I think you probably need a mix of all sorts of different products within that bucket. It's just the old diversification thing. Have some passive funds, have some what they call active funds, invest in New Zealand, invest offshore, just have a whole mix of things in there. And then you'll get some of the action no matter which way the markets are heading or which type of product is outperforming another. So, I mean, passive funds work really well in a rising market, obviously, because you're paying low fees and the market keeps going up. They don't tend to be so good in a falling market. So it's all horses for courses, and you don't bet all your money on one horse, shall we say.
And you mentioned about financial advisors. How do you choose a good advisor? And is it best to use a large, well-established company or an independent advisor who might have been recommended by word of mouth, say? Right.
So there's a website called financialadvice.nz that has a directory of financial advisors on there. Again, look, I think it really pays to shop around and find somebody that you feel you can work with. It's more about the personal relationship and having trust and confidence in the person yourself. And you can really only assess that by going to meet someone and having a chat with them and seeing if they talk your language. Some advisors might use a lot of jargon and technical words, or others more approachable. It's about having a good working relationship with somebody. I guess the downside of some of the larger companies is you do get a bit of churn in the advisors, because they will come and go a bit. Whereas if you're using an advisor that has their own business, they're not going to just suddenly up and leave you in the lurch. So if you're wanting a long-term relationship, perhaps go for a smaller, more boutique firms. Look, they have their pros and cons. Obviously, in the large companies, you've probably got access to a lot more research and resources, and a lot of them use, I guess, standard portfolios. So really just find out as much as you can about the company that you're working with, and find somebody that you feel comfortable with, but refer back to that. Well, a good starting point is the Financial Advice New Zealand website that has a directory of people, and you're looking for someone that has expertise in investments. The pinnacle qualification for a financial advisor is being a certified financial planner, and those people have the initial CFP after their name. So that's their little title, little blue symbol that appears.
And we have another, I'm not sure we'll be able to answer this one, but how do we change the New Zealand media culture of falling rates are good and rising rates are bad, to the point that the impact of changing rates on older investors in particular is rarely ever mentioned? So it's not really very balanced reporting. So
oh, absolutely. They're appealing to the mainstream, aren't they? But look, I totally agree. Yes, and yes, falling interest rates are not good for retirees, that's for sure. But in saying that, I do want to point out that the money you have in the bank, you shouldn't look upon it as investment money. It's actually spending money. You should only have money in the bank that you want to spend in the short term. So really, the interest rate you get for it should be neither here nor there, because you're just parking it somewhere safe until you want to spend it. Where you're focused on return is on your medium and long-term buckets. And so interest rates have a much lesser impact in those two buckets. So think of it that way.
And another one here, what should I do with my KiwiSaver when I retire?
Right, so KiwiSaver is a very useful product, and I believe that pretty much every retiree should have at least something in KiwiSaver. So you can use KiwiSaver for one of your buckets. It's a bit hard to use it for more than one bucket, because you have to choose, investment profile for it. So you could have KiwiSaver for your long-term bucket, put some money in there and just do set and forget and say, well, I'm going to touch that when I'm 80. You can also use KiwiSaver as a place to keep money that you intend to give to your family. So, we talked about who's going to spend your money. If you want to leave some money for your children and grandchildren, you can pop that into KiwiSaver. Again, it's set and forget until such time as you pass away, and then it's wound up in your estate. Some people use it as a just-in-case fund. So just to have money in reserve in case something unexpected happens. Perhaps if you've cancelled your health insurance because the premiums have got too high or whatever, and if you've got a bunch of money sitting there in your KiwiSaver, that can be like a health emergency fund. So there's lots of different uses for KiwiSaver. I guess the key advantage of it is it's a relatively low cost fund, but just make sure you're in the right investment profile. So just because you're retired doesn't mean to say it needs to be in a conservative fund. Again, it's all about when you plan to spend that money. So if you're setting it up as a long-term bucket, you would probably want to look at putting it into a growth fund of some sort rather than in a conservative fund. So again, just matching that investment strategy to the time frame.
And we have one more here, which I think fits in well with the time that we've got left. Should I invest in gold and silver for a safe investment?
Oh, it's very tempting, isn't it? You know, some people say, well, look, everything's turning to custard, you know, the world's, you know, falling apart. Should I invest in gold and silver? And honestly, I would really discourage you from that. You know, there is a saying in investment circles that investing in precious metals relies on what they call the greater fool theory. So because those metals don't tend to have a lot of intrinsic value in themselves, you know, there's not a lot you can do with gold and silver other than invest in it. So really, to get your money back, it relies on somebody who is more foolish than you, shall we say, wanting to buy it off you. So look, they're no more safe and secure than a lot of other investments. Gold and silver can be very volatile, and like anything, like if you want to dabble in it, then just don't put a huge percentage of your funds into products like that, which are really, in my view, quite speculative, along with things like Bitcoin, you know, again, speculative. So yeah, stick to the tried and true would be my advice.
Super. Well, thank you very much. That's the last of our questions. So if nobody has any more, then I think that's us for today's session. If you do think of something and you just get offline and you wish you'd asked it, again, please send your questions to the email, and we will get to them either before or at the next session. So thank you, Liz, so much for your time in your session today. Much appreciated. I've also gone off with something that I feel is useful for me. So thank you very much. And thank you all so much for taking the time to be here today. I hope this session was useful for you and you got what you hoped from it. And it would be wonderful, and we would be very pleased to see you at our next session in October on estate planning. So yes, thank you all very much.
Thank you. Thanks, Kirsty.
Thank you, and take care, and we will hopefully see you next time.